And latest figures show the U.S. economy is doing better than anticipated. Fourth quarter GDP revised upwards and consumer sentiment hitting its highest level since 2021. But the encouraging economic data comes in the wake of that Baltimore bridge collapse earlier this week, and that could take a financial toll on the wider economy. Our Owen Fairclough has more.
A tragedy that claimed the lives of 6 men working through the night to maintain a critical bridge supporting one of America's critical ports. And the ramifications of the Baltimore bridge collapse are easy to grasp for the surrounding communities.
And let's always start with the family first. The families that have lost people, the hardships that are going to go along with not having the bridge.
The container ship that crashed into the Francis Scott Key Bridge brought the country's #1 port for importing and exporting vehicles to a virtual standstill. The workers who keep it running among the first economic victims of this disaster.
We are concerned about the local economic impact, with some 8,000 jobs directly associated with port activities. And we are concerned about implications that will ripple out beyond the immediate region.
At least new data shows the broader economy is moving in the right direction to support that impact. Growth for the last quarter of 2023 was revised upwards on Thursday, reflecting revised forecasts for 2024 that chime with unemployment near historic lows. Even so, companies including Amazon and Under Armour, who set up shop to leverage global supply chains on their doorstep in Baltimore, are also likely to be affected. So those whose livelihoods depend on those supply chains are anxious.
We can't ship anything out right now, so the exports have been shut off. So obviously there's nothing we can load in containers to go out of the country because there's no vessels to load it on. The vessel traffic has stopped. So, and with no incoming containers, that will be shut off as well. So sooner or later, the port's going to just quiet down. It's going to be, hate to use the word, but almost like a ghost town here.
But just how long it will take and how much it will cost to bring Baltimore's most important asset back to life again is yet to be determined. Owen Fairclough, CGTN, Washington.
And that better than first forecast GDP figure was due in large to higher consumer spending and business investment. Consumer spending grew 3.3%, up from 3% in the previous estimate. Separately, weekly jobless claims in the U.S. fell to 210,000 last week. That underscores a labor market that remains resilient. And more key data coming out on Friday. The Federal Reserve's favorite inflation gauge, the Personal Consumption Expenditures Index, is out and may help determine the Fed's timing of interest rate cuts. And 2 more closing records on Wall Street Thursday. John Terrett has more on that from the floor of the New York Stock Exchange.
Well, despite all the talk of can the rally be sustained and will the Federal Reserve actually cut interest rates later in 2024 or not, we did finish the week and the month and the first quarter of the year very strongly, with 2 new closing records. This is how the markets finished on the Thursday session. The Dow was up 1/12%, 47 points, to stand at 39,807, closing record. The Nasdaq, though, was down by 1/12%, 20 points. Tech having a bit of a tough time at the moment. The S&P 500, though, up just over 1/10%, 5 points, to stand at 52.54. That is another closing record. I believe it's the 22nd over at the S&P 500. Bitcoin having a good Thursday, up 3% at just about 70,000. And now it is Friday, and the stock markets of New York will be closed on Friday in observance of Good Friday. It's not a federal holiday in America. The banks will be open, but the stock market will be closed on Friday. However, because it's not a federal holiday, we will, at 12:30 GMT on Friday, get PCE. It's an important piece of inflation data. It's the one that the Federal Reserve looks at most closely and prefers to read. So that's all ahead on Friday. John Terrett, CGTN, on the trading floor of the New York Stock Exchange.
And to help us take a deeper dive into the latest eco data, we are now joined by Han Despain, a professor of economics at Nichols College in Massachusetts. Hans, thanks so much for joining us. So final read for fourth quarter GDP comes in hotter than expected, 3.4% versus 3.2%. Real GDP in the third quarter increased 4.9%. And for all of 2023, GDP grew at 2.5%. Your reaction to that, and what were the key drivers for growth?
Yeah, well, the numbers are very good. Thanks, Karina. They came in higher than expected, as you mentioned. The key drivers are producing good industries, private producing good industries, especially petroleum and chemical industries, coal. And also in the private service industry was especially retail trade, which would bode well for the future of the economy.
Yeah, and then looking ahead, PCE, personal consumption expenditure, the Fed's preferred gauge for measuring inflation for February, comes out. Economists expect it to be higher. If so, it would be the second consecutive monthly rise. How does that impact rate cuts in your opinion? Because the Fed's Waller was very clear, saying there's, quote, no rush to cut the policy rate right now. So does a strong economy give the Fed some leeway, some breathing room to wait longer, looking for the confidence that Powell said it wanted?
Yes, I would expect no rate cuts with this newest report, and primarily because of the retail trade. So the Federal Reserve will be anxious about inflation returning. So if the numbers for March come in a bit higher, there will not be any rate cuts, and even potentially a rate increase could be a possibility.
Oh, that's a very interesting opinion. So, are we seeing, in your opinion, then a second wave of inflation after a period of disinflation? And to that end, are rates sufficiently restrictive enough at the current moment to get us back down to the bank's 2% target? You say we might see a rate hike in the future.
Well, these things are very hard to predict. However, I suspect we will not see inflation return in any sort of significant way, and primarily because there's a lot of headwinds and weaknesses that we have. So even though unemployment is low historically low at 3.9%, if you look at U6, which includes part-time workers that would like full-time work, it's at nearly 8% unemployment. So that's a little bit higher than we'd like it. And there's a lot of Americans that don't make a lot of money. So there's a Ludwig Institute follows what they call functional unemployment, which includes the unemployed part-time workers that would like full-time work, but also anybody that makes less than $25,000 a year, and that number's at 25%. So a quarter of Americans are what Ludwig Institute calls functionally unemployed. So there's a lot of Americans that are not participating in any sort of robust way in these good numbers.
Yeah, it seems like it's a tale of two cities. Professor, is this Fed truly data dependent, as it says it is, or is it determined to get at least one cut under its belt by this fall to cover its bases? And when do you see the first rate cut coming?
Well, that's a good question. I think we'll see a little bit of inflationary pressures. I will be surprised if we see a rate cut in 2024, frankly. So, but it could happen at the end of the year or the beginning of 2025.
So you believe that the Fed will not cut rates anytime this year, and they'll wait till the following year. That's a very interesting insight that you've given us. Markets just wrapped up a record-setting quarter. The S&P closing out their best quarter in 5 years, up by 10%. But there have been tailwinds that have helped, right? A strong consumer, labor strength, and the expectation of several rate cuts. Do those tailwinds now dissipate?
I think so. I'm not very optimistic with a particularly strong stock market. But again, these things are very, very hard to predict. It will depend on what investors think the Federal Reserve will do. I guess if you're pessimistic about a rate cut, that would hold back the stock market.
And so where are we, do you think, in the cycle? Because 2 months ago, everyone was saying that we're at the end of it. Now you hear from some people we're mid-cycle. Some people say we're early cycle. Where are we in all of this?
Well, again, I like the way that you put it, Karina. It's a tale of two cities. We have a lot of folks that are doing very, very well in this economy, but there's a lot of people that aren't. So it's a very, very, confused moment to decide exactly where we are in any sort of business cycle or otherwise.